Welcome, everyone. My name is Elena, and I will be your host for our 2025 Mid-Year Economic Outlook. Thank you for joining. Our speakers today are the talented and respected advisors Mike Razzouk, Diana Saylor, and Robert Bullock. Before we get into it, there are a few disclosures to note on the screen. This webinar is being recorded and will be made available on our website and posted onto our YouTube channel as well. We will be taking questions at the end of the presentation. We simply ask that you type your questions and/or comments in the Q&A box below. And now it's time to settle in and have Mike lead us off into our 2025 Mid-Year Economic Outlook.
Great. Thank you for tuning in. Today we wanted to break this up into 4 different sections. We tried to go off of what clients tend to ask us the most. And so I felt like we couldn't begin without market volatility. I think what's kind of interesting about this year is if you just opened up a statement today, it probably would have felt like it was a pretty average year. But we all know there's a little bit of a roller coaster ride. And so we want to jump in, talk about that a little bit, and just give some overall thoughts about volatility in general. So I put this first chart in here because we know that stocks tend to go higher over time, not all the time. And I think that's a key distinction. And what I like about this is it really highlights all the different things that we've gone through over time. You know, the markets have survived wars, depressions, invasions, assassinations, and all kinds of different events. And, you know, we've had a global pandemic, and now it seems like we're dealing with elevated tensions between Israel, between Iran, you know, Russia. We're still dealing with Ukraine. So there's always something to be worried about. And if we drew a trend line on this chart, you'll see that, again, markets go higher over time.
I'll pop in. They go higher in spite of the bad news. They go higher because capitalism, one thing I like about capitalism is somebody's always coming up with a new idea, a new cure, a new solution. So I look back in the 1920s is when the car was just coming out. 40s and 50s is where household appliances, the washing machines were just beginning. And obviously in the 90s was the computer, and these days we're doing with AI. There's always something new, and people want to take advantage of it. And that's one reason why the market goes higher over time.
And we got the same, the market climbs a wall of worry. And I think, Robert, you probably lived through most of these events. So any key takeaways that we should keep in mind?
Yeah, I'll start with the panic of 1906. Carrie and I were around back then. Saved by, the economy was saved by JP Morgan, but I digress. Keep a long-term view. One thing I don't like about this is that when you see those jaggeds going down, like in 2008, that's a 50% decline in the market. So it is a roller coaster. Always remind yourself of that. You're in it for the longer term, and you're always compensated for taking that longer view and not trying to get in and get out.
And that's the point, is that there's always something going on. There will always be something going on. And you know what? Just worry about what you can control and look at your own plan, and that should help you get through it. And don't look at your statements, like Bob said.
One of the biggest things is like bad news sells, right? That's why all these charts just show all the bad news and all the reasons not to invest, but they don't show, like Robert was talking about, all the amazing things that happen, the innovation, you know, the wonderful changes in technology. And I always like what Carrie says, at the end of the day, people want to educate their kids. They want to take them to Disneyland. You know, life goes on despite bad news. So it's just inevitable. It's part of the process. And so let's move on to the next slide and talk about that. What's the old saying? Buy the rumor, sell the news. And right now, you know, we again are dealing with high tensions with, you know, possible invasions. We don't know what exactly is going to happen here with the Middle East and just some of the events that are transpiring. But I think what's interesting is whenever we face major geopolitical events, if we fast forward just a year, the average return is 14.2%. So in other words, markets tend to be higher after we go through the event. And so it always feels anxious. So it always feels like, wow, there's a new novel reason not to do something, not to invest. And yet markets continue to go higher over time, like I mentioned. And usually once we get past that bad news and the initial shock, people start to feel better. They continue their spending, and life tends to go on.
Yeah, it's always a reminder that what goes down always goes up. As simplistic as that is, it's true. And this chart sort of reminds everybody If we are going through something difficult, I hate to say it, but it also represents an opportunity maybe we can take advantage of. But first, it's to get through it, and then to remind yourselves that the markets always recover. Otherwise, why would we ever take the risk of investing in stocks, bonds, or real estate for that matter?
And the average return that we're seeing here, 4.2, that's higher than what the average annual return for the S&P is. So that's just a representation of after events like this, the market tends to overreact, and then we have a decent recovery.
Right. And, again, it's not that we want to be immune to risk. We don't want to minimize anything. To me, one of the biggest things that tends to scare markets and shock them temporarily is if you have oil spikes. So, it doesn't mean, hey, we're laissez-faire and we don't watch things closely. Of course we do. But, we have the historic perspective enough to be able to say, yeah, this isn't fun right now, but if we probably wait, things will be better in the long term. And we just have to get through this little short term. So let's go to the next slide, Alana. Okay, I felt like this year, we couldn't talk about volatility without mentioning the tariffs, right? I think that's probably one of the biggest reasons why we saw such a big spike down in the markets. And so what I wanted to do was focus a little bit more on just the concept of expectations with markets, because really markets go up or they go down based on expectations. If a company comes out and they report earnings and it's better than expected, stock is going up. If it's worse than expected, stock's going down. And so I got the question, I don't know if you and or like Diana or Robert, if you did too, but hey, how come you guys didn't change our investment strategy when you guys knew that there was going to be tariffs? Well, the market expected there to be tariffs. And so really it was, were the tariffs better or worse than expected? That was really what was going to drive the market. And so what we can see here was we had phases, right? Trump got elected in November and he immediately started talking about implementing tariffs. So it wasn't like it was a surprise, and yet the market continued to go up. But as he changed his rhetoric and said, okay, we're going to start with, 10% tariff on China, and then we're going to slam in 25% tariffs on Canada and Mexico, and then 145% tariffs. I mean, the market just kept on reacting to that new news. So it wasn't just something that was simple and predictable. And let's go to the next chart, because I feel like this really illustrates what was happening with the markets. And so when we take that tariff announcement and we overlay it with the S&P 500, you could see they were directly correlated, meaning that as tariffs went up, the stock market basically was going down. And this was an immediate reaction to that new news. And I just want to remind people that on Liberation Day, so on that April 7th announcement, we essentially had a 11% decline within a 2-day period. I mean, the market just completely reacted and did not expect, reciprocal tariffs on top of flat tariffs. And then as the rhetoric tapered back and it looked like, oh, okay, these aren't actually going to go into effect as proposed, the market started to regain its confidence and its footing. So lots of stuff works on expectation and was the news worse or better than expected. And that's really what's going to drive the long-term market direction.
And I just remind everybody, let's see, March, April, and May, it's 3 months. You're a long-term investor. You're investing literally for the rest of your life, 20, 30, 40 years, we hope. And to react, if you will, over a 3-month period is not healthy, if you will, for long-term returns. And so, yes, the tariffs create uncertainty. Yes, the tax bill before it was finally passed created uncertainty. And that uncertainty is both harmful for consumers. Maybe they won't spend as much. And it's also harmful for businesses. Maybe they won't grow or hire as much. But we always work through this. But once again, don't react to short-term events.
And on a positive note, we've looked back at times in history, it's about 6 or 7 times since the 50s that the market has pulled back 10% or so in a couple of days. And the positive thing there is usually on average, the market is up about 18% over the next 12 months. So as we saw before with some of those geopolitical events, that the market usually recovers pretty nicely when you have overreaction like that.
What tends to happen is all the negativity gets washed out of the market. The people who are going to sell. And then smart investors come in and they see opportunity. They say, wow, I love these companies. I can buy them on sale. I'm going to add money to my portfolio. And then it creates that cascade effect. People start having that FOMO, fear of missing out effect, and then they start piling money in and you get a recovery. So I'll say, this decline in the recovery was a lot faster than what people expected. And I think in reality, this has been one of the most hated market rallies that we've seen because it happened so quick. But, I think the key thing to take away here, Elena, let's go to the next slide. This is normal. I think, again, we kind of forget a little bit here that volatility is just part of the investment process. But what I mean by normal is it's very common for the third year of a bull market to experience choppiness. And so this is where we are. We're about 2.6 years into the bull market. It really began in October of 2022. And when we go back and we look at other bull markets in history, it's very common for that third year to be choppy. So I think what we forget a little bit here is we just came off of 2 back-to-back years of almost a 25% return in 2023 and 2024 for the S&P 500. And so for things to take a little bit of a pause, it's very normal. I tell people the markets take 2 steps forward, they take a step back, but then they take 2 steps forward again. And that's why, again, when we look over time, markets go up, not all the time, as I said before, but this was very common volatility. And I think the nice takeaway from this chart is when you look at the average run of a bull market, it's usually 5 to 7 years. So we're still a little bit early. That means that there's still likely opportunity ahead.
So Mike, you're telling us that the bull market's got legs.
I think it does. I mean, I really do. If you believe in history and it repeating itself, I think it's very likely.
Historically, obviously, it makes sense, and like you said, Mike, coming into this year, we already expected volatility. Tariffs aside, tax policy uncertainty aside, whatever the concerns were, we already knew that it was going to be volatile. Now, the two-day 10%, 11% correction, obviously, that was a little quicker than we anticipated, but there will always be volatility and maybe more so this year.
Right. And with that, I mean, you can't necessarily predict 2-day volatility. And when it happens, best thing to do is just kind of close your eyes a little bit to the volatility. Like, Robert, what do you tend to do with your statement during volatile months?
I don't open them.
No, I don't think people believe us when we say that, but I just try not to even look. I mean, I don't think that there's ever been a wise decision that happens with an emotional reaction.
Right. We all practice what we preach.
That's right.
Yeah. Okay, let's move on to the next slide. This is one of the things that was giving me a lot of confidence, I guess, through this period. And so we call this actions speak louder than words. And what I mean by this is, especially when it comes down to money managers, to investors, you got to look at what they do, not what they say. There was so much pessimism. And to put it in perspective, CNN actually does a sentiment poll. And they number it between 1 and 100. 1 is basically the world is ending, the sky's falling, big meteor is going to come and take us all out. 100 is everything's perfect and rosy and just, rainbows and sunshine. Guess where the poll landed? At a 2. So in other words, most investors were as pessimistic as they've ever been. I mean, more pessimism than they had during COVID, when we had everything shut down. We couldn't go to restaurants, movie theaters, all that. That was the level of pessimism that investors were showing in the months of March and April with these tariff announcements. And yet, what they were doing with their wallets was completely different. They felt like, oh, things are terrible. I'm going to go buy a car. I'm going to go buy a washing machine. I'm going to go spend money. I'm going to take a trip. That's going to help me feel better. And so all those actions, that spending is actually driving the economy higher and keeping us in a pretty strong position. And so I always try to look at not what people say that they're doing, but what are they actually doing with their pocketbook? Because that's what's really going to drive the markets and the economy.
And I'd highlight once again, that's really important. 70% of the US economy are you and I spending, are the consumers spending. And what's amazing is with such low unemployment in the low 4%, if Americans have a job, what do? They love to spend. And so I'm not surprised that they're spending. They may have a different attitude, but once again, what's important for the economy is the spending. And we had retail sales numbers this morning, which were better than what everybody thought.
And they'll continue to spend, albeit maybe it's on different things. Maybe They'll lower spending on non-essential items. But what's interesting in this chart, you can see at the beginning of 2025, there was a spike there in spending, and I should be attributed to basically the tariff. So a lot of people went out and purchased certain things in anticipation or ahead of the tariffs, and then you could see the decline there. But it's starting to tick back up, and we don't really see a decline in spending going forward, especially we have low unemployment. Also, we have new tax policy, which could potentially put a lot of extra funds in people's pockets. And what do when they have extra cash? They tend to spend.
Yeah, and what I'll point out is you can even see back in 2022 where we had a pretty severe bear market. Spending barely was impacted. And so again, I'll assert at this point, post COVID, it seems like we've just become addicted to spending, and the trend doesn't seem like it's slowing down at this point. But again, that's optimistic for a higher economy and good news for an unlikely recession. So let's move on, because I think again the key takeaway of this whole section is volatility is the toll that we pay to invest. It is normal, and what this is showing us is how many dips you should expect in a given year. So it's average for us to experience 7 3% dips in the market, 3 5% corrections, 1 10% correction annually. And then, a little bit less common, but a 15% decline usually happens every 2 years, and a bear market every 3.5. So we just have to accept that this is going to be part of the investment process and not be surprised when it happens. I remind people we can't necessarily predict bear markets, but we can prepare for them. And that's one of the biggest roles that we try to do as risk managers, with diversification and just making sure that people have, sufficient cash to get through a rainy day, and enough assets that they could, pick on something that hopefully is doing well while they wait for their stocks to recover. So yeah, it's just part of the process, again, of investing and getting higher returns than fixed assets over time.
And Mike, that 5% mild correction that's staring at me, a 5% correction on the Dow would be a drop of 2,200 points. It'd be splashed all over the news on CNBC. Bad news once again sells, and we're gonna at some point have a correction. It's normal. It's healthy, frankly. But what do I do when we go through the next recession? As Diana mentioned earlier, honestly, I don't open up my statements. I turn off the TV, and I would suggest you do the same. Go out and play with the grandkids and throw the ball outside. Keep your hair from growing gray.
Yeah, I think I'm going gray enough for all of us.
Yeah, it's really important too. This chart is great, just that it shows the expectation of the kind of volatility that we could see. And so that's important so that you can go through it easier.
Yeah. So we talked about, what's happening with volatility just in general. And so the next thing that we wanted to focus on here was interest rates, and then just talk a little bit about some of the changes that we just saw with tax policy. So, Robert, would you like to take us away and talk to us a little bit about what's happening with the Fed?
Yeah, a lot going on with the Fed. We'll see whether any changes in personnel over the next couple of weeks. But the chart on the left reminds me what the Fed was projecting when it comes to inflation. That's important. When tariffs were announced, you'll see the upward move from the high 2s to the low 3% was expected for this year in 2025. But if you look out, inflation does drop to the mid 2s and then down to the target level of 2% 2 years out. And so inflation may be higher than longer. And obviously the tariffs had an impact. Once again, tariffs are a tax. Somebody's got to pay that tax. Either the companies eat that tax, which could potentially impact their margins and their earnings, which would be negative for the market, or the companies pass that tax on to the consumer. And once again, that would be inflationary. And so higher for longer, but definitely dropping closer to the 2% target that the Fed has 2 years out. On the right, it's how many rate cuts are we expecting? After the announcement of the tariffs in 2025, earlier this year, still expecting 2%, two rate drops sometime this year. Probably won't occur now, this month in July. maybe in September, maybe in the fourth quarter, but still expecting two. Still expecting a few more in 2026 and a few more in 2027. Any rate cuts is gasoline to this economy. It speeds up the economy, and that's good for both consumers, frankly, and it's good also for the markets. And so I'd like to see some rate cuts. Are we going to get them? We'll see. I mean, inflation stays high, unemployment stays low. I think it's going to be a hard explanation for the Fed to lower rates, but at least at the moment, we are expecting some rate cuts later this year and into next year as well.
Yeah, I'd say the interesting thing that we just saw an inflation print yesterday, right? And in that inflation print, I mean, we saw inflation go up from, I think, 2.4 to 2.7 year over year. So it's actually still coming in a little bit less than what the Fed's expectation was, from this June chart, albeit the year isn't complete. But it seemed like the major areas that actually ticked it up, it was energy costs. It was, automobile, like used car sales. It was stuff that honestly didn't have much to do with tariffs. And the biggest thing that actually fell was the price of oil. And as I had mentioned earlier, it seems like oil is the thing that has its tentacles in everything. When you tend to have low oil prices, it tends to be disinflationary for other things as well, and help mitigate, some of that increase that people are anticipating. So it didn't really seem like it was tariffs that really impacted this print going higher.
Yeah, and the largest contributor to the inflation report was rent. And so you're right, it doesn't seem like the tariffs have contributed to inflation. So it'll be really interesting to see. It's hard to justify at this point any rate cuts, but we'll see.
And so what does the Fed do if the economy is slowing? The economy is still growing, but it's definitely growing slower this year compared to last year. Unemployment is still historically low, but it has kicked up from about 3.5% unemployment rate last year to about a little bit over 4%. So the Fed doesn't want the economy to slow too much, and there's a lag time as to when they lower rates as to what that would be positive for the economy. This chart shows in the middle, if you will, the minute they do a rate cut, it takes about 6 months to a year for those lower rates to pass themselves through the economy to try to speed the economy up. And so the Fed's in a difficult position of when do they cut? It can't be too early. It could be inflationary. It can't be too late. Otherwise, we actually go into a recession. And so the team at KWB will continue to monitor both the inflation rates, the Fed when it comes to the interest rates, but also the unemployment rate to see if and when the Fed's getting closer to actually doing something.
Yeah, it's got to be a tough job being a Fed chair. I mean, you can't win either way, right? And I think what's kind of happening is nobody wants to be the Fed chair that we saw in the 70s, where okay, we're going to take our foot off the brake a little bit and start to taper back interest rates, and then you get that reacceleration of inflation. And so I think every Fed chair at this point wants to be Volcker. We're going to crush inflation. We're going to do it at any cost. And, damn the markets and the economy if we have to. We're not going to let inflation come back. So it's a tough job, but yeah, I mean, it just, there's a delayed impact. And if they cut too late, the risk is you enter too much of a slowdown and you fall into recession. So hopefully we'll see some rate cuts soon, and it's that fine balance.
It's called threading the needle.
Yeah.
Yeah, it's a hard job. We saw that back in 2022, but I believe when they were a little late in raising rates. And so it's a really tough job. We'll see what happens. Let's switch gears a little bit. We were talking about monetary policy. Let's talk about taxes. So as many of you are aware, the big, beautiful bill was finally passed right before the 4th of July. So we just wanted to go over a few key highlights that may impact most of you. First off, the 2017 tax brackets were made permanent. This is huge. As many of you know, the tax brackets and tax rates were set to sunset at the end of the year, and rates were going to be a lot higher. So this is a very good thing. Secondly, the increase in standard deduction by $1,500 for married couples, $750 for a single filer. The SALT deduction, us Californians, we are really happy about this, and also New Yorkers. We were capped at $10,000 for quite some time, and so now the cap has been increased to $40,000. And then there is a phase out. If you are married and your income is over $500,000, the phase out begins. If you are a single filer, it's $250,000, and then the phase out begins. Next, we have the estate tax exemption. It was increased. This year, it's actually 13.99 million per person, so about 14 million per person for 2025. It increases in 2026 to 15 million per person, 30 million for couples. No tax on tips and overtime. So there is a cap on this. It's $25,000 in income, and it will sunset in 2028. The offset tax on Social Security. So there was a lot of discussion about not having Social Security taxed. That was not added to the bill. And so in lieu of that, what they have done is they have added an additional senior deduction. So if you're 65 and over, it is increased from $1,600 to $6,000 per person, but there are some income limitations. So if you are married and have income under $150,000, you are eligible for this. If you are a single filer, it's $75,000. So there's some income caps there. Also, there's an increase to child tax credit from $2,000 to $2,200. And then lastly, the clean energy deduction, or credit rather, that starts to scale back September 30th. So just a few items here we wanted to highlight. If you have any questions about your personal situation, happy to go over this with you or conduct some analysis. But anyway, we just wanted to go over a few items.
You need to go have more kids.
When I look at this, there seems to be an asterisk at the end of all of these, either an elimination or a limitation or an income range. It's going to be a challenge for the local CPAs.
Yes, the most important thing is the top three, those are permanent. So at least we can rely on that. So the tax brackets, standard deduction increase, and the SALT deduction, that's permanent until we get another majority and they make changes, but everything else will get phased out through 2028. So at the end of 2028.
Yeah, well, and just to add, I think a lot of people with the no tax on Social Security, it can't happen with a reconciliation bill. We have to keep in mind here that there was a very slim majority with House and Senate. And so, this had to be a reconciliation bill, which could pass with, just a simple majority vote. You don't need that 60 votes in the Senate to get it through. And so as such, it just isn't going to happen with reconciliation. It may be a subsequent bill, but I think the $6,000 standard deduction increase was meant to just, help offset the tax, since they couldn't do anything, within a reconciliation bill.
I'm just glad that they did something, because it's one of the things that was sort of holding back the markets is the unknown with the tariffs, the unknown with the tax bill. Now that we've got an idea as to what the taxes are going to be, individuals and companies can do some long-term planning and start growing it again.
Yeah, and I think we didn't necessarily highlight here. I mean, this was mostly for individuals, but think if you were a business and you potentially had your tax rate jumping up to 35% again. I mean, the bill here kept corporate tax rates at 21%, and so it is a pretty positive change for revenue for companies, which tends to translate to higher stock prices. So yeah, now they got that certainty. They know we can deploy this capital and not have to pigeonhole it away for additional corporate taxes. Okay, so we talked about volatility. We talked about interest rates. I think one of the things that's kind of happened is as interest rates fall, the money that people have had on the sidelines in money market and treasury bills, it becomes a little bit less attractive. You might want to start considering other alternatives. So we just wanted to talk about some considerations with cash as those notes come due.
So we're always going through the bargain bin, looking for value, looking for opportunities where they may present themselves. And I'm going to highlight municipal bonds. Yeah, it's not for everybody. It's really if you're in a 32% tax bracket, a high earner, as to what do you do with that extra cash? Well, we all know of taxable options like CDs and money market accounts, which are paying 3.5 to 4.5% these days. But once again, if you're in a higher tax bracket, muni bonds got crushed at the beginning of the year because when they were working out the tax bill, it got leaked out that maybe municipalities were going to lose the ability to issue tax-free bonds. And so there was a rush by municipalities in the US to sell those bonds. So we had a massive supply of muni bonds come to the market. That crushed prices, which drove up yields. And as the box in the middle says, you can buy a muni bond paying 3.8%. But because of the tax equivalent yield, once again, you got to be in a higher tax bracket. It's offering at 6.5%, a heck of a lot better than CDs and high yield money market accounts. And so it's an opportunity that presented itself. We're bringing it to clients' attentions that we feel can take advantage of it. And once again, we're always hunting for opportunities that present themselves and bring it to our clients' attention.
And there's two ways to potentially make money with bonds. You've got your interest rate, which, like you're highlighting, Robert, can be attractive if you're in those high brackets. But you also have price appreciation potential as well. Most people aren't going to hold a bond until it matures. They're usually going to sell it at some point. And so if you buy a bond and interest rates fall, the price of your bond actually goes up. You can sell it at a premium. So, you have the potential to sell a bond at a higher price plus an attractive interest rate if interest rates fall.
And the other thing to keep in mind, so those of you that have funds in a money market or CD or T-bill, so the rate that we're seeing currently is about 4% in the low fours. And so what you've highlighted, Robert, is that bonds generally are ranging from 4 to 5% or something. So if you're willing to take on additional risk potentially with bonds, you could earn a higher yield. And then, like you said, Mike, there might be some price appreciation if we see rates fall in the coming year.
Absolutely.
So this chart's really interesting. A lot of the questions that I get are, we had a lot of volatility earlier this year. We had that 11% pullback. And so from February to April of this year, we didn't quite hit the bear market definition, if you will. So the market dropped total almost 19%. And for those of you that don't know, a bear market is defined as a 20% decline. We did hit the 20%. It was intraday, but it didn't close. And so what this chart is basically showing is that all the bear markets that we have had, since the 50s, and it shows that we have more room to grow even after recovery. And so what this is showing as far as the end of the bear market, so the market drops 20%, at that end, even after we see a 20% recovery from that low, the market tends to go even further. And on average, we see 3 months after hitting that 20% recovery, 3 months after that, we see on average, the market increases 5.5% over 3 months, 12% over 6 months, and 19% roughly over the next 12 months. So clients ask, well, wait a minute, we're already up 20, 25% from the lows. Are we going to stagnate? Is there much room to go from here? And the answer historically would be yes.
So the trend is our friend, it seems.
Right.
Yeah, I think that's the key, is just, it's not like, wow, the market's gone up 20%, I've missed it all. Typically, there's momentum behind it. It has those legs, like you mentioned, and it will typically continue to go higher. And so I think a lot of people get nervous from new highs. An all-time high tends to make people hesitant about getting into the markets. But, when you go back to those charts that we were showing earlier, markets are typically making new highs. It's just, again, part of the process, the growth of the economy, more people entering the workforce and wanting to spend. It's just part of that investment process.
This is our famous quilt chart. I'm sure most of you have seen this before. It kind of looks like the periodic table of elements from high school. And so what this represents is various asset classes that are represented in different colors. It shows the rate of return of each of those asset classes back to 2010. It shows up to 2024 through 2024 and also year to date. But what you can ascertain from this chart is there is not one color that is all the way along the top, and there isn't one color all the way along the bottom, even though there are a couple of colors that tend to be at the bottom. What we want you to focus on are the white boxes. So that is an asset allocated portfolio of around 60% stocks, 40% bonds. And so if we don't know what's going to do the best every year, then we really should be diversified. And we'll talk about diversification here in a minute. Basically, the definition of diversification is accepting good enough while missing out on the extraordinary to avoid the terrible. And as you can see on the far left, the average annual rate of return of an asset allocated portfolio since 2010 is a little over 7%. And so if you have cash that's on the sidelines, not your emergency funds, but if you have some additional cash that you're willing to maybe take a little more risk, maybe the time frame of these funds has changed, you might want to take advantage of an asset allocated portfolio. So a little over 7%.
Diana, I take it looking at it from a retiree's perspective, 7% return. That means I could pay 1% to my advisor. I withdraw 4 to 5%, which is what we would suggest to clients if you've got a pot of money and you want to withdraw from it and never run out of cash. If you could live off of 4 to 5%, that leaves 1 to 2% still that could keep up with inflation. Means I never run out of cash. And so, and I don't have to go through the high highs and the low lows. It's a boring process, but it's a process that works.
And what I'll highlight, I literally like the fact that cash is on this chart. You know, it shows all the way back to 2010 that it's been about a 1% return for people over time when, you know, markets were doing 14, 10, asset allocated portfolios were doing 7. And so it's definitely more risk being invested. And that's why we just always try to make sure that as advisors and practitioners, we're asking very good questions about what is the time frame for this money? What kind of expenses do you have coming up? What we're doing is we're wanting to ensure that this is money that can be invested for a longer period of time in case we do experience some short-term volatility. So, you know, I think that there are some good alternatives which we're trying to highlight and just show that, hey, if the rates become less attractive because interest rates fall, there are some other things to consider that, you know, might be able to get people good returns with reasonable risk levels. So let's continue on with the theme of diversification here a little bit. So, you know, the last section that we wanted to talk about was diversification and just, you know, navigating uncertainty. So let's highlight that uncertainty bit here first. And so I feel like you can't have a outlook without talking about the R word, right? Recessions. And what I like, this is actually put together by Franklin Templeton Funds, and they call it the anatomy of a recession. You know what they do? They look at 3 key areas to determine what's happening, and we look at these as forward indicators. So they're looking at things like the consumer. Are they strong? What's their sentiment? What's happening with jobs, with wage growth, retail sales, business activity? They're looking at costs of commodities. They're looking at profit margins, shipments. And then the financial sector, you know, what's happening with the yield curve, with money supply, credit spreads, you know, that's a really big one. And so when we look at this actually compared to the end of 2024, what's interesting to me is a lot of metrics either stayed the same or may have actually improved, you know, so it's actually stayed pretty stable. And so I guess I would say if you felt really great at the end of 2024 about the economy, the markets, you know, the overall direction, things are pretty much on par. And what I feel like has been interesting really this year is most of the economic news that was coming out was better than expected. You know, despite tariff announcements and those fears, you know, we were having lower unemployment rates, we were having higher job growth, we were having lower inflation prints than expected. And so I would say it's very unlikely that we'll experience a recession in 2025. And so far, there's a lot of positive momentum going into 2026.
Yeah, the news is pretty positive, which we'd like to remind clients. It may not be highlighted in the press, but you still have really low unemployment rate. Anything under 5% is considered full employment. We're just above 4%. You've got inflation that's going slowly in the right direction, which is lower. It's under 3%. And so I would still be looking at the Fed, inflation, and interest rates. The other thing I'd be staring at when they announce every month would be the unemployment rate and job growth. Those are the two areas that I'd be focusing on.
And once we get some certainty around the tariff situation, I think some of the risk indicators here are because of the tariff situation. A lot of these businesses are unsure of where we're headed. So once we get some answers there, we could move forward.
All right, let's move on. I feel like this is an interesting topic because, a lot of people have been looking at the stock market and, saying it's expensive. And I think what's interesting about this is it pulls apart the biggest 10 companies in the S&P 500 versus the other 490. And we look at a metric that we call the price to earnings ratio. It's basically what are people willing to pay for $1 of real earnings that a company produces. And historically, that number has been about 16 and a half, maybe 17. And so when we look at the biggest companies, their price to earnings ratio has been over 24. So in other words, those are very expensive. But the rest of the companies in the index have actually been quite a bit cheaper, closer to 19 times. And so I feel like it's really important to keep in mind that it is important to have exposure to other companies, not just the biggest 10. And, people have gotten addicted to those mega cap stocks, but really those are the ones that are expensive and have actually been driving up the average price of the S&P 500 index by themselves. So, there's this interesting phenomena where your biggest companies are making up almost 33% of the index, and they also tend to be the more expensive ones.
And they're expensive for a reason. What's the typical earnings margin at your local grocery store? It's 1 to 2%. If you look at these large companies, 40% of the S&P market cap are companies that have profit margins of 60% or more. Remarkable. They're printing money hand over fist. That's one of the reasons why people are willing to pay up to purchase those stocks.
Right. And let's look at the next one. So Mag 7 seems like it's been the buzzword in the finance industry now for probably the last 3 years at least. And I think what's interesting about this is we can, again, see what happens when we separate those 7 companies. And those are going to be things like your Apple, Microsoft, NVIDIA, Tesla, Meta, Google, those companies. And what we see here is they've actually had a little bit of a rough year. Almost all those companies, I think Meta excluded, were in a 25% drawdown at some point, through that tariff announcement, Liberation Day, April. And as of when we printed this chart at the end of June, that basket was still down about 3%. Where if you had the other 493 companies, in their own separate basket, you were actually up 4.2. So you had almost a 7.5% spread between the other 493 companies versus the Mag 7. And I think what people also tend to forget is if you go back and we rewind to 2022, most of those Mag 7 companies were in an 80% drawdown. And I feel like that's why they've had a good couple of years. A lot of that was just recovery. And, it takes a pretty big recovery when you're down 80% to get back to all-time high. So, I think it's important to just keep in mind that there is other opportunities, and sometimes the other companies in an index actually do better than the largest ones. So, we still encourage people to be diversified. Don't be overly concentrated in just 7 or 10 companies. And I think what I really like about indexing just in general is it is freaking hard to consistently pick winners.
Hey, if it was that easy, we'd all be calling in from Tahiti today, wouldn't we?
Yeah,
Yeah.
essentially. But
Go ahead, Mike.
I was going to say, you look at professional investors like Warren Buffett, for example. He attributes most of the return of his portfolio and outperformance of the market to like 2 or 3 really good trades. And, again, he's known as one of the most influential and best investors in our time.
My statistic I always tell clients, if you're trying to pick stocks as opposed to using the smartness of an index or a mutual fund, is 1% over the last 30 years, 1% of all the operating companies on the stock market produce 80% of the wealth. Try to find that 1%, not just this year, but for the next 10 to 20 to 30 years. It's really difficult.
That's amazing. And I think Warren Buffett also, he's been investing for what, 83 years. So time more so has been on his side for sure.
Yeah. Well, and again, I think that's why we choose to do an indexed approach, because, when you're buying individual stocks, you got to know when to buy it. And also you need to know when to sell it, because if we look at the S&P 500, the constituents of it today are significantly different than what we had, 20, even 30 years ago. So, it's very difficult to just consistently pick winners, know when to sell them, and how to harvest those profits. So you don't have that exercise with broad baskets and indexed approaches. Okay, so let's talk a little bit deeper about diversification overall. So we just kind of talked about, mega cap versus owning other companies in terms of, their market cap, but let's look at other asset classes too. What I like about this is it's really showing what was happening overall this year with a diversified portfolio. So as of June, the end of June, diversified portfolio was up about 4.5%. What this is showing is over half of that return was attributed to international stocks. So really we've seen a pretty significant outperformance in international companies this year versus U.S. companies. And, other things added value too. Bonds, for example, if it kind of helped cushion the blow. I mean, we were at one point down 20% almost in U.S. markets. And these other asset classes really helped prevent portfolios from seeing a significant decline. And so I think that, it's been a little bit of a frustrating road for international companies. I mean, we've kind of jokingly in the industry called diversification for some time, but it does add value over time. And that's why we still think it's important to consider it and practice it.
So my international stocks are finally doing something for me. I'm still waiting for my small caps.
Yeah.
Finally, international, we just got off the longest time period in history that the US has outperformed international stocks. It was about 15 years, maybe even longer. So finally, and many of you probably know this, but in your portfolios, certain portfolios, we have a little overweight to international. And so that has worked well.
Yeah, let's move on to the next chart, because I think it really highlights the outperformance that we've seen. And also it highlights the diversification that you get with international stocks. So I feel like there's a couple components. One, I feel like international stocks just as a asset class got a boon because there was a lot of companies that were being forced to spend. There was a lot of build in military and lots of European countries, for example, that were trying to arm themselves still for these foreign wars. And so there was additional spending, but on top of that, the dollar was actually declining in value. We saw the dollar drop about 11%. And what happens with an international stock is when you buy it and you hold it, it's actually owned through local currencies. And so when you go and you sell it, what ends up happening is you're selling it in that local currency and converting it to dollars. So you actually got to benefit from the fall of the dollar in addition to just the profits that these companies were experiencing. So you look at the chart there, I mean, there was some countries that experienced 30% increases or 20% increases at the time that the US markets were only up about 2.5. So, if you're worried about the dollar and the decline of that, maybe it's not going to be reserve status or something. International stocks are a great protection for your portfolio and that diversifier from that currency risk as well.
Well, we talked about a lot today. So we wanted to just point out a few key points from today's discussion. First off, expect market volatility. It's always here. It's here to stay. We'll probably have continued volatility this year, just especially with the uncertainty around tariffs. So just have that expectation. Call us if you need us to hold your hand or talk you through it. Likely higher inflation ahead. We'll see what happens here. There may be some rate cuts beginning third or fourth quarter. We'll see how inflation pans out. The tax policy, we finally have some answers there so we can move forward. But as I said, we're still waiting for tariffs and some answers there. And then we have seen a nice recovery since the bottom in April, but according to history, it looks like we have some more room there. Historically, returns have been favorable after that point. And then lastly, stay diversified for a smoother ride.
Love having you all, and we want to make this a great event. So feel free to offer any questions, comments, or concerns. If we didn't answer your questions, send an email to invest@KW Wealth or contact your advisor. Lastly, thank you guys again for joining and have a great day.